The first of 5 reasons that you can retire with less than 500,000 is that you likely have additional income already, like Social Security, pensions, annuities. And instead of factoring this in, you're thinking about your net worth instead of your income. For context, my name's Daniel, founder of McCluskey Financial, and it's not uncommon that we see with a potential client, they want to get to some rainbow number, 500,000, a million, 2 million, but don't instead focus on what that number can actually accomplish for us. So if your goal is $3,000 a month in income adjusted for inflation to be able to retire, we need to find out how to get that number, whether it's with 500,000 or 1.5 million, we just want to retire. And the way to do that is once you have factored in your existing income from things like pensions, we just need to find out how much additional money we need and then a strategy to have that money paid to us, of course, in income. So as an example here, if it only costs you $3,000 a month to retire and you already have a $1,500 a month Social Security benefit, well then your nest egg, or how much money you need, needs to produce $1,500 a month in extra income. And a strategy, if we are just focusing on income as opposed to net worth, to be able to do that is something what we call the baseline strategy. Essentially, what this is you are finding a way to guarantee, in terms of just income, your baseline needs. If $4,000 a month would be pretty comfortable to you, but you can definitely live on $3,000, that's your baseline. We want to find out how can we guarantee $3,000 a month, so $3,000 minus what you already have from pensions, Social Security, whatever that number is, guarantee that so we have this baseline covered. It's going to be much less stressful for us because we have that covered. And then anything on top of that, this would be considered additional money, a bonus, or that's the money that we could choose to live a little bit above just our needs. Now, how you actually accomplish this strategy is going to be through the means that we mentioned in the first one, the pensions, Social Security, annuities. You can actually buy your own pension, usually going to do this through some form of annuity. Most people are familiar with how when you're going to receive a pension, a teacher, someone in the military, a lot of the times they have the option, instead of just taking the payment for the rest of their life, to receive a lump sum. The same thing goes the other way. If you have money in a 401k or an IRA, instead of just using the standard 4% rule, you also have the option to roll it into a pension and start receiving an income from that. So if you look at what private insurance companies, for example, are offering, all you need to do to cover the rest of your baseline is work backwards from the additional income needed. So let's say that was $1,500 a month, $18,000 a year, and see how much money would I have to give an insurance company as a lump sum up front for them to guarantee me that for the rest of my life, I'm going to receive that amount of money. So once you've determined that, which of course will depend on interest rates, age, what companies are currently offering on the market, all you need to do from there is actually buy that income. Then of course, anything on top of that is just a bonus. That's the baseline strategy. Just one quick example here of what this looks like. This is a joint annuity of a couple aged 66 and 65, not adjusting for inflation, but you can see with $311,000 at their ages, if they turn this on immediately, they would be able to receive $21.3 thousand for the rest of their life, as you can see there, guaranteed lifetime income withdrawal, and that is far greater than a standard 4% rule with $311,000, which might be closer to a little bit north of $12,000 a year. Of course, that would adjust for inflation. The 21.3 would not. We're going to cover this a little bit later to show how this usually is actually even more income, even though this doesn't adjust for inflation. Of course, not guaranteed, but we'll get into that later. So that's reason number one. You likely have additional income already, and you can focus on income as opposed to net worth and maybe be able to retire with much less money up front or much earlier than you might have thought. Second is it doesn't have to be that expensive, or at least as expensive as you might be expecting. For context, these are the average retirement savings, and this is not the median. By the way, these are the average. The median is much lower than this. We have 537,000, ages 55 to 64, and ages 65 to 74, we have 609,000. So if this is the average and the median is way below this, that means tons of people are already doing this. And if they're doing it, of course, that means you can do it. I'm not going to get into specifics in terms of maybe you have to move into a cheaper location, maybe it's cutting subscription costs, maybe it's going out to eat less. You've already heard all of those things. A couple examples of channels if you want to watch people who are actually doing this in real time. Right here, 3 different YouTube channels that are actually documenting their progress and kind of going through how they save money in different ways. If you are in that scenario where you really do need to cut down costs and you want to get creative, which you don't have to, of course, good resources there. But I'm sure you've probably heard of plenty of ways you could save money. It's just a matter of if you actually want to. And please, reason to be here. Stop blaming inflation. I know it's very annoying. It is a form of theft. They are printing more money year and year and year again, basically to reduce the purchasing power of your money. However, it always amazes me when I see articles like this. Just when I saw the other day, the salary a single person needs to live comfortably in all US 50 states, they say it's over 120,000 in 2 different places. The cheapest one they had on that list, and that's why I included these 3 states here, is West Virginia. A single person to live comfortably, they are saying $80,829. That is absolutely absurd for a single person. I don't know what they're defining as comfortable, but it's these articles and these people that are always talking about how horrible inflation is, how they basically can't even afford some decent standard of living without making 6 figures or more. It's total nonsense. This is absolutely not what you need to live comfortably. Families of 10 are living on this. Now, that's probably very, 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 very difficult, but it is possible. And if it's possible for them, it certainly can be comfortable for a family of 2 to live on $36,000 a year if they are cutting out expenses and being prudent with their spending and saving. Reason number 3, you don't have to leave an inheritance, or at least a very large one. And there's 2 points with this. First, I'm going to hit on the technical point. Second, I'm going to talk about some other effects of leaving an inheritance. So technically, let's say that you need $2,500 a month, or that's how much you have in Social Security rather, and then you need another $1,000 a month that is going to continue to increase for inflation. That's the number that you need to survive. If you are using the standard 4% rule, so let's say that to get that extra $1,000 a month, you have $12,000 that you need in a yearly basis. You would divide that by 4%, and that would give you $300,000 that you need to be able to retire. Assuming this adjusted at 3% a year for inflation, again, totally hypothetical, could be higher, could be lower. But when you do this and you're using a basic 4% rule, generally you aren't going to run out of money. And what I mean by that, because I'm not guaranteeing that in any way, is that if you're using a rule where you're only pulling a small percentage from your retirement account each year, if markets start to go down or we go through a rough period, generally people, as opposed to running out of money, will just take less from their account. And because that's the case, they'll wound up leaving an inheritance. And because they were just taking less of their money, and maybe they thought this was the only way, they end up leaving an inheritance basically just because they were wanting to make sure that they were okay in the first place. However, you don't have to do that if you purchase some sort of income for yourself. So this ties into point number 1. We're going to look at this very clearly. If you were just wanting to use that basic 4% rule, and let's assume your money is growing at 6% a year, compounding every single year, but you're pulling out 4%. We have these numbers on the left. The 300,000, you pulled out 12,000, so we're assuming that 300,000 minus the 12,000, that is the $1,000 a month that you need, and then after that, multiplying the remaining amounts by 1.06, otherwise growing by 6% a year. As you can see on the left here, that's what that number does, the 305,000, all the way down to 30 years later. It's about 291,000. You were able to take this money adjusted by 3% every single year for inflation. At the end, you're receiving about $30,000 a year in income. Now, what's the problem with this and what scares people about this? That is, in this second example, all we did was have 2 years that we didn't put at 6%. We have 1 year, year 4, at minus 10%, and we have 1 other year, in year 7, at gaining 0%. So just staying flat. If we do that, and we need to continue to pull out that 4% from our initial 300,000, adjusting for inflation each and every year, what happens? By the end of year 30, you're out of money. in basically just 2 single years of slightly different, -10 and 0%. Of course, we all know things can be far, far worse than this. People get scared. And because that's the case, a lot of times they will end up working much longer than they need to have a larger nest egg to pull. Maybe even it's less than 4% out in a given year, or less than 4% of that initial money later on in retirement, because they're scared of running out of money. So sometimes that will cause them to work longer, and in the end of things, they'll end up leaving an inheritance they didn't really intend to leave behind. They just had that extra money there, basically just to make sure that they would be safe for themselves. Now, on the flip side, if you did not work those extra years and put that $300,000 into, we are assuming, a fixed index annuity with a guaranteed lifetime withdrawal benefit, paying 7%, you can do it taking single, taking it joint, doesn't matter. We saw in that previous example, 311 was paying a little over 21 jointly with a little bit of a death benefit there. So if we just say that this is taking it single for a single person, again, it doesn't matter that much for this example. And then we have this number here. So same calculation as before, that 300,000 minus the income we took out, and then growing by, we chose 3%, so no higher than 3% in every single year. We have it running out of money in a little less than 20 years in terms of how much you would leave behind. However, it pays this $21,000 for the rest of your life. Now, what you might be thinking is, well, in year 30, it's giving me $21,000. But if we go back to the last slide, we saw we needed $30,000. So even though this doesn't run out of money in terms of income, it's not giving me enough. However, what if you didn't spend the additional money that you didn't need in the early years? Because also up here, we're getting 21,000, but we only needed 12. So if you took all of the additional money and didn't let it grow at all, you stuffed it into a mattress that you didn't need to spend in the early years, there'd be $97.5 thousand there. In the late years, the additional money that you would need on top of the 21,000 is less than $56,000. So without that money growing at all, you would still be able to fund all of that, and this is contractually guaranteed by the insurance company. Whether markets go up, down, sideways, it does not matter. They're planning to give you, guaranteed by them, $21,000 of retirement income for the rest of your life until you pass away. And if you took the additional money, kept it in cash, wasn't growing at all, you would still be able to, with 100% confidence, assuming the insurance company does fulfill its requirements and you don't get your money stolen from your mattress, pay for, assuming inflation was only growing at a steady 3% for the next 30 years, that extra $1,000 adjusted for inflation with ease. Now, of course, however, you are leaving less behind, at least most likely, but not necessarily in this scenario. So let's look at, again, not how this affects our net worth, but tying this in with point number one, how this affects our actual probability of success of being able to retire and our comfort levels with doing that. So here we have, and this is again totally hypothetical, scenario number one, if you kept the $300,000 in the market and you were trying to just get $1,000 a month adjusted for inflation. So we're not factoring in that $2,500 a month for Social Security with the cost of living adjustment. If we're just solving for the 1,000, assuming baseline growth, just a plain baseline scenario here, no RMDs are required, you have, in terms of probability of success, around 82%. Of course, this isn't guaranteed, it's a Monte Carlo simulation. Other horrible things could go wrong, but just according to the software, they're showing an 82% probability of success. Now, if we started off with a bad decade, followed by moderate growth, we can see, of course, we have an income shortage of a little over $150,000. So this might be more likely to leave an inheritance behind with a probability of success of about 82% of our income being there, but that also might cause us much more uncertainty. Maybe it causes us to work much longer, and instead of doing it this way, let's look at scenario two, where we have an annuity that we bought with that $300,000, and then we took actually only the additional money that we didn't need in the first 5 years and put it into a taxable account. We see our probability of success, according to the software, goes up to 100% from 82%. This also is not including the extra 14 years of money that we had additional money, over $40,000 that we didn't save, we didn't let it grow at all. The software just assumed that we just spent that additional money for all of those 14 years. We still have the probability of success of 100%. are you going to leave an inheritance behind in this example after, say, year 20? No, you are not. However, you can retire with much more confidence because no matter what happens to the market, you have this money here no matter what. And the additional money that you need here in the yellow in both situations is funded by the money that you saved that you didn't need to spend in those early years. So again, this is the technical reason behind you don't have to leave an inheritance. Sometimes, while this may reduce the probability of you leaving an inheritance, doing something that has more guarantees behind it may increase the probability of success in your ability to retire with far less than $500,000. Now, secondly, the other point behind leaving an inheritance is many people are familiar with, I've seen Dave Ramsey quote this, is in the Bible, Proverbs 13:22. There is the verse, "A good man leaves an inheritance to his children's children." However, 3 points. Number one, older English translations don't say this. They say the good man leaveth heirs, sons, and grandsons. Second, a spiritual inheritance as well as character traits are far more valuable, one could argue, than a financial inheritance. And number three, a financial inheritance could be just about the worst thing that you could give a struggling heir. Of course, that is not going to be the case for everyone. That is why we underlined could be in that sentence. But sometimes to deprive someone of struggling or going through and building character traits, getting through hardship, is exactly what they do not need to progress in life later on. We've seen stats of big beneficiaries of trust funds, for example, and people who are given money to pay for their entire livelihoods. Sometimes this is detrimental. Hey, and real quick, if you're finding this video helpful, leave a like and let me know. Thank you. The fourth reason is that there is something called the retirement spending smile. Essentially what this says is as time goes on in retirement, adjusting for inflation, people tend to spend less and then that comes back up. So if your current expenses are around $100,000 and we're adjusting for inflation with this money, most people will plan for this blue line, which is basically I need $100,000 every year for the rest of my life because that's my current cost of living. What the retirement spending smile has shown from a great body of research, and I'll include the link to the source of this in the description, there's plenty of them out there, is that it dips down and tends to look like a smile. So around age 84, we have here, it's dipped down to as low as $74,000. Again, this is accounting for inflation and then starts to go back up after that due to added healthcare costs, etc. I made another video here where I go into much greater detail, but again, another reason why you might be able to retire earlier is your expenses might not be as high as you think they're going to be. And finally, the fifth and final reason you can retire with less than $500,000 is it may be more preferable to retire early on a cheaper budget than continuing to work longer, dealing with the stresses or your struggles with work, and retiring later on a bigger budget. Of course, you would have to do some sort of comparison here. This is not going to look the same for everyone, but a lot of the times people are very sick of working and want to stop and get into retirement. So if looking like this guy here, just drinking a coffee, living real peacefully, sounds a whole lot better than working longer, looking like this guy here, but then being able to have a bigger budget, this is something you may want to consider. If you're within 10 years of retirement in the US, subscribe. I release videos for you twice a week on how to do that peacefully.